Digital Asset Group is a division of Brian Kelly Capital Management. I don't know how many of you guys are familiar with Brian Kelly. If you trade in the stock markets, he's on the show Fast Money, which comes on at 5 o'clock. He's on about 3 times a week, one of the stock analysts, and he is the one who is definitely most focused on Bitcoin, having written a book about it, and being sort of with the ethos of a lot of the sort of, maybe burn it down kind of thing. We have put together a portfolio based on what we think that this asset class can do. Now, we're not a blockchain company. We're not a technology company. We're technology leaning, but we're trading. We're buying Bitcoin. Not just Bitcoin, but a lot of Bitcoin. We think that there are a lot of very interesting technologies that are emerging in the space. And we think that, as it says, the disintermediation is going to change how we transact, and more importantly, how we distribute capital. We're trying to position ourselves at the center of this paradigm and take advantage of that. We think that institutionally, Bitcoin is still not ready, primarily for reasons of custody. It's too hard to keep Bitcoins from being stolen, frankly, for the Alabama Teachers Pension Union to start buying them. But we are running the portfolio to build a track record for when they do to be the ones they come to. I mean, obviously they're going to buy ETFs, but some of them will be active. We are investing in projects and protocols that we think will do the best job of flattening finance and accomplish kind of the goals and missions of what we're all looking for. We prefer things that have defined use cases, that we know what we can do with it, rather than sort of being like amorphously, like we can change everything or do everything. A phrase that a test that we try to apply to everything we look at is, are we trying to boil the ocean? Because that's hard to do. So our portfolio is primarily, at this point, consists of 4 core positions. I mean, we trade around a lot of the altcoins, but frankly, there isn't an institutional grade exchange where our threat modeling and risk tolerances allow us to keep enough money to do anything with it. Ethereum being the primary protocol that we are investing in at the moment, although we have a very significant stake in Cosmos. You may not yet have heard of Cosmos. You've probably heard of Tendermint. Cosmos is a network being launched by Jay Kwan and Ethan, who created Tendermint, that uses Tendermint Core as the consensus protocol for it. It actually looks a lot like Ethereum. It doesn't have a scripting language built into it, which we think is not a big problem, because there are plenty of scripting languages that can be applied. And we think it potentially can scale more easily than Ethereum can right now, because it begins as delegated bonded proof of stake rather than having to switch to there, and also has a mechanism which allows local consensus. We think allowing local consensus and communicating it back to sort of like sidechains, but native, makes a lot of sense. In terms of the 2 largest positions, they're Bitcoin and Monero. Actually, Monero is now our largest position. The defined use cases of Monero and Bitcoin are very, very clear compared to everything else, because people are using them to transact. There is definitive and provable and findable transaction volume in each. And other than, frankly, I guess Steemit, there really isn't anything else being used. We think Steemit is actually very interesting, but we're trying to do an analysis, and it's been difficult so far. We think Steemit is going to be a really, really good buy when the price of Steemit falls below the price of a YouTube impression, because then it would be. But it's kind of hard to do that math, so we're waiting. We also are looking at DApps. It's hard to find DApps right now that are super compelling, because a lot of them are based on protocols that, while we believe in and are extremely promising, don't really work yet. And not only do they not work, but like it's stated that they don't work. They're not supposed to work in their current state. They're supposed to be test beds where people are building on. And that's interesting, but it's kind of like, you know, trying to invest in computer and internet technology like really early 90s. Like a lot of them go up a lot, but I don't know if they're going to make it. And given the sort of flavor of the portfolio we want to present and the money that we eventually, I mean, we've raised capital, we're trading a portfolio, but the kind of money we want is institutional capital. And we don't think that we're going to attract institutional capital by buying and selling very small positions and very illiquid things that end up not being there. We think that generating alpha against Bitcoin is really enough to position ourselves the way we want to be. And then finally, we think that the ICO market, while incredibly hot and incredibly important, is also, you know, like super duper dangerous. Not so much for the people that buy it, but for the people that issue it. And there's a distinction between DApps and then like network owning coins or whatever they are, but the bottom line is it's equity. At some point, it's going to need to like be realized that it's equity. And it's not to say that anybody who's done this is going to get in trouble. Particularly, you know, like no one's going to get in trouble for an ICO that went off and everybody made money. Like there's no injured party. I mean, look at Ethereum. It did so well that nobody gives a shit about the DAO. Like, it's unbelievable. But that's because you put $600 in the Ethereum crowd sale, and you had like, what, 25K at the peak, 30K? And you still have a whole lot. You still have $18,000, $20,000. So there's no injured party. And that's going to continue to be the case for a while, but at some point there's going to be a problem because, you know, I was at a dinner with one of these guys who's putting on a new network, and we were discussing it, and their lawyer asked us, what's the Howey test? Which, if you don't know what the Howey test is, it's how you determine if what you're selling is an investment or not. The space is not yet ready for the kind of capital that's flowing in. The problem is it's like the capital is coming no matter what you want. No matter whether you're ready or not, the money's coming. So one of the things we're trying to do is work with outfits who want to raise capital properly. You know, there's all sorts of different ways to do this. An interesting idea is Title III of the Jobs Act allows unaccredited investors to invest, I mean, up to 10, but without having to really do any work, up to $2,000 a piece, and the company can raise $1 million from them. So, I mean, if you look at the way these ICOs have actually worked, one of the ones that sells out in 5 minutes, it's not just small investors. There's a number of big investors who put money in. Those are qualified accredited investors, and then there's small investors. I don't see any reason why you couldn't organize a crowd sale where you raise $1 million worth of funding from small investors and have the large investors line up to fill up whatever other capital requirements there are. And that's what we're doing. We're building, I mean, to say we are not building any tech, we're building a piece of technology to help further that, but we're using a very powerful new blockchain called SQL. So it's not, you know, it's not exactly okay, no SQL, whatever. Cassandra's fine. The point is that, you know, it's less blockchain and more QuickBooks for hedge funds, or for capital raises, whatever you want to call it. But yeah, I mean, it gets into the point of what a lot of people are trying to build, because the settlement systems and stuff could use a serious upgrade. I'm not sure SQL wouldn't be a big upgrade from the 50 trillion lines of COBOL the financial system's built on now anyway, but we'll get to that, I suppose, when we get there. But again, that's sort of, you know, not what we're focused on. And it's not that I don't appreciate it. I mean, I spent time at Factum and at ItBit. At ItBit, I sort of led the bank chain project. And it finally, I got tired of it. I mean, the technology side is really hard, and as many of people at this conference will know, the Bitcoin side's a lot more fun. So that's kind of been the focus. I mean, we do trade small positions in other currencies. Certainly some of the privacy currencies certainly have a lot of beta, and some of them have a lot of alpha, and they're very interesting. we took a very long, hard look at Zcash versus Monero, and I'm not sure that Zcash doesn't have better tech. I'm not sure if they do. Monero has some pretty great tech, and with adding Ring CT, it's pretty good. But here's the problem. You can't have any transactional volume in a coin that doesn't have any coins. So, it's kind of hard for it to actually get used for anything. And that's sort of why we lean towards, that's sort of why we're in Monero and as our play there. We didn't initiate a largest position in Monero. It kind of took care of itself. But again, that'll probably end up being trimmed, not because we don't like it, but because our main goal and the focus of what we're doing is trying to beat Bitcoin. And if that means that we're in 100% Bitcoin and we're trading euro versus dollar on the other side to try to create alpha, that's what we'll do. Because what we think is truly, truly lacking in what we hope happens in the next 3 years is a credible institutional, New York-based financial firm that buys and sells these things, and offers custody solutions in a way that are accredited and insured. That's a big thing. Bitcoin insurance is a real problem. I know that some of the guys at BitGo, Jonathan Silverman's done a phenomenal job at getting insurance policies written, but whether they'll pay out, like whether they'll consider what happens to be an insured event, it's about as good a guess as guessing which exchange your coins are safe on. So it's really difficult. That really is the biggest impediment to institutional acceptance, because if it weren't for that, Bitcoin right now, if you look at asset allocators, okay, their main job is to allocate to assets. Well, their main job is to make money. Everybody's main job is to make money. But their main job is to allocate to assets that do well and don't correlate. If you do a regression analysis on Bitcoin in the last year, it's up like, in 2 years, it's up like, I don't know, triple digits, and it has the highest correlation it has. The only one that even measures as statistically relevant, which means more than 5% correlation, is to like the Vanguard real estate ETF. And obviously that's just noise. Like it really doesn't matter what's happening in VNQ versus Bitcoin. But it doesn't correlate to gold. It doesn't correlate to the dollar. If you run the regression analysis, it has under 5% correlation against every major asset class. If you have an asset class that is considered institutionally viable, and it's performing like that without correlation, and you're an asset allocator and you don't have it, you suck at your job, like badly. So there's gonna be a tipping point if things continue. Now, when that happens, it'll start to become more correlated because capital flows will dictate that it does. And there are a lot of other things that we see possible as potential upside catalysts for Bitcoin. The one that we think is most promising is Bitcoin as a value store. Now, I understand that is a little bit of a difficult problem because by itself, Bitcoin really sucks as a value store because value stores aren't supposed to go up and down a lot. But there's enough of an appetite for Bitcoin that if you found a way that capital for instance, couldn't go into the banking system, marijuana, legal dispensaries, right? They can't take credit cards. If you could get them to process credit cards and put the money into Bitcoin, you could probably find somebody willing to take the other side of the volatility. I'd do it. We would take the other side of the volatility on that trade. And what would you have? You'd have an influx of capital into Bitcoin that was actually using it for something that banks do, storing value. You'd remove the volatility for the merchants because, dispensaries aren't like looking to hold Bitcoin as part of their business model. And you'd make a flywheel because what is it? It's a $5 billion a year industry. You capture 20% of that. I don't think that anybody can credibly make an argument that anybody's ever started putting $1 billion a year into Bitcoin. And doing it not like completely price insensitive on a regular buy day, like buying every day. So there are huge catalysts that could take Bitcoin higher if it becomes used for something in the financial system. When that happens, if that happens, I'm not sure. But our basic premise is to be positioned for that or for just the continuation of sort of the interest being peaked. I mean, you look at like Needham, Webbush has been on Bitcoin for a while. Needham put a $5,600 price target on Bitcoin like a month ago. I mean, that's a credible Wall Street firm saying that this thing is going to go up like 500, 600%. That's totally fucking bananas. They don't say that about anything. But those of us who've been here for a while know that that actually does happen. So maybe from a lower basis, but on a log scale, it doesn't really matter where you are. So I mean, I guess that's pretty much the spiel. If anybody has any questions about trades or what we're doing, I'm happy to talk about it a little bit. Again, most of the positions. The core positions I already told you are, actually no, it's Monero, Bitcoin, ETC and ETH, and then Cosmos, but Cosmos hasn't ICO'd yet. It should be in the next month or two. We funded them before. So, any questions? Okay, so Bitcoin is not correlated to the dollar index. The DXY. DXY is a basket of currencies that are used to price something against simply the dollar. Everything always has to correlate exactly to what it does. It's like sort of like saying the dollar's going down, so the price of everything else is going up. But if you broaden the dollar out to the Dixie, which is the dollar against a rank, it's mostly euros, some yen, whatever, ranked currencies, it doesn't correlate against the basket. It's under 5%. It could have been time series. We did a 2-year regression analysis. We did it manually, and we just asked Wolfram, and got the same analysis. I mean, a little bit different, but again, statistically irrelevant. I'm using 5% as a level of statistical relevance. 1 in 20 doesn't. Under that, it's generally accepted that it's done. Doesn't matter because it's 3 z-scores. Okay, so how's Cosmos structured so that it's acceptable to us? Okay, so what we want to do, going back to the equity-linked tokens, is we want to help people set up ways to raise money through coin sales that are secure, that are perfected securities interests in the equity underlying the asset. That means, though, that they're not tradable the same way, they don't do the same things, all sorts of stuff. But it's a bridge that's going to have to get crossed somehow. Cosmos is not set up like that. The Cosmos Foundation is a Canadian, there's a Canadian company, a US company, and they're selling the network tokens, which are the staking tokens. They're collecting donations for the staking token, whatever. For them, there's potentially legal pitfalls in the future. For us as the buyer, there isn't. Yeah, well, that happens a fair amount in Bitcoin. Well, altcoins, whatever. But yeah, no, we're confident enough, we know enough about this tech, we know enough about Jay, and certainly enough about Tendermint, to believe that what I said about Ethereum will hold true here. Like, there's not gonna be any injured parties. This goes right. I know Tendermint is a protocol that was highly sought after from the sort of private blockchain people because two of the different companies I was working for tried to buy it. Okay.